He did everything right. Not in his own opinion, by the rules. He paid every bill before the due date, sometimes days early. He kept his balances low, always below the recommended limits. He never missed a payment, never argued with a bank, never asked for special treatment. For years, the system rewarded him for that behavior. Higher limits appeared quietly. Better interest rates followed. Pre-approved offers came and went. Nothing dramatic, just steady approval. He became exactly what the credit system claims to value: reliable, predictable, low risk. At least on the surface. The first sign that something was wrong was so small he almost ignored it. A transfer between accounts took longer than usual. Not failed, not rejected, just slower. He assumed it was a technical issue. Banks have outages, apps lag, that happens. He didn't think about it again. Over the next few weeks, the delays continued. Payments that used to clear instantly now took hours, sometimes a full day. Still nothing officially wrong. No alerts, no warnings, no messages explaining anything. Just a subtle change in how the system responded to him. Like a conversation where the other person suddenly starts answering more slowly. He checked his credit score. Excellent. He checked his payment history. Perfect. Nothing negative appeared anywhere. According to every visible. What he didn't know was that it had been thinking for a long time. Credit systems don't react in real time. They observe. They collect data quietly over months and years, building patterns that no user ever sees. They don't care about individual actions. They care about behavior trends. And more importantly, they care about changes in those trends. At some point, his behavior shifted. Not dramatically, not irresponsibly. He didn't miss payments. He didn't take on debt. He simply adjusted. His spending rhythm changed slightly. One month, his utilization was higher than usual, then lower again. There were longer pauses between transactions. To a human, this meant nothing. To a system built on prediction, it meant uncertainty. Uncertainty is not neutral in financial systems. It is risk. Not moral risk, statistical risk. The system doesn't fear people who struggle. People in debt behave consistently. The system understands them. What it doesn't trust is deviation. Someone who stops behaving exactly as expected. Someone whose future actions become harder to predict. That was when the second sign appeared. The offers stopped. No more pre-approved increases, no more balance transfer suggestions, no quiet invitations to upgrade or expand, just silence. At first, he didn't notice. Most people don't. You only realize access is gone when you try to use it. One morning, he attempted to move money between two accounts. The transaction went through, but again, slowly, slower than before. Still not broken, still not enough to complain about, but enough to feel watched. He called customer support. The representative was polite and calm. They verified his identity, asked routine questions, typed for a while. "There are no issues with your account," the voice said. That statement was true. There were no errors, there were no mistakes, there were no violations. There were decisions. What the representative could not say was simple. Credit systems don't respond to what you did yesterday. They respond to what they believe you might do tomorrow. Behind the visible score, other metrics were updating. Behavioral indicators, velocity models, deviation markers. None of these appear on credit reports. None of them can be disputed. He hadn't failed the system. He had confused it. And systems do not tolerate confusion. They manage it. By slowing things down, by reducing flexibility, by quietly creating distance. By the time he understood that something fundamental had changed, the system had already adjusted his view of him. Not enough to cut him off, not yet, just enough to watch him more closely. That is how modern financial control works, not with loud denials, with hesitation. That night, he went to bed believing everything would return to normal. After all, his credit was perfect. What he didn't realize was that perfection had made him visible, and once the system notices you, it never really looks away.
The days that followed were quiet but heavy. Nothing collapsed, nothing exploded, and that was what made it worse. His accounts stayed open, his cards still worked, his score remained high. On the surface, his financial life looked untouched, but underneath, the tone had changed. Every interaction felt slower. Transfers that once cleared instantly now took hours. Approvals that used to feel automatic now hesitated. It was as if the system had begun to pause before responding. Not refusing, not approving, observing. He checked his credit report again, and again. Still clean. That number was supposed to be reassurance. Instead, it felt meaningless, because the score wasn't what controlled access. It never was. Credit systems are built in layers. The score is the part people see, the part they're taught to care about. But behind it exists another structure, one that doesn't explain itself, one that doesn't ask permission. Behavioral models. Those models don't measure morality. They don't care if someone is responsible or careless. They measure probability. They calculate what kind of customer you are likely to be next month, next year, next cycle. At some point, his profile stopped aligning with what the system wanted, not because he stopped spending, but because he stopped behaving the same way. He paid balances down faster than before. He let cards sit unused for longer periods. He relied less on revolving credit and more on his own cash. To him, this felt like progress. To the system, it looked like withdrawal. Withdrawal is a warning sign. A customer who depends on credit generates data, interest, fees, predictable patterns. A customer who starts pulling away introduces uncertainty, and uncertainty is treated as risk. That risk didn't trigger alarms, it triggered caution, invisible, algorithmic caution. The system began reducing exposure, not dramatically, subtly. Limits stopped increasing. Requests took longer to process. Certain options quietly disappeared. Nothing that could be disputed, nothing that could be proven, just less flexibility. He noticed how often the word review appeared now. Internal review, routine review, automated review. No one could tell him what it meant because no one actually knew. He spoke to another representative, then another. Each conversation sounded the same. There were no problems, no negative marks, no violations. Everything was functioning as intended. And that was the truth. The system was not broken. It was doing exactly what it was designed to do: protect itself. Credit systems are not built to help people become independent. They are built to manage dependence. A customer who relies on credit behaves consistently. A customer who reduces reliance becomes unpredictable. And unpredictability threatens the model.
He began to understand something unsettling. Responsibility is not the goal. Engagement is. The rules encourage good behavior, but only within a certain range. Pay on time, use credit regularly, maintain balances, not too high, not too low, just enough to stay active. He had moved outside that range without realizing it. The system didn't see improvement, it saw deviation. As weeks passed, the effects became more noticeable. A purchase that once required no approval now triggered a delay. A financial tool he used to access easily was suddenly unavailable. Still no rejection, just resistance. Resistance is how systems apply pressure without accountability. There is no message to argue with, no decision maker to appeal to, only behavior that changes, and silence when you ask why. He searched for answers on his own. Stories surfaced. People with excellent credit who suddenly stalled. People who did everything right and still felt blocked. Different situations, same outcome. No explanations, only patterns. The truth was uncomfortable. Credit is not a reward system. It is a control system. The score is not trust, it is a snapshot. What matters is trajectory, direction, momentum.
He realized that the system had categorized him, not as a problem, as a potential exit, someone who might stop playing the game, someone who might not be profitable long-term. Profitability is the silent metric behind every decision, not fairness, not effort, profitability. Once that metric shifts, everything else follows. He tried to adjust, small transactions, regular activity, just enough to signal engagement. The system responded slightly, but not fully. Because once a profile changes, it doesn't reset, it adapts. That is how flags work. They are not punishments, they are memory. The system remembers uncertainty longer than it remembers compliance. It remembers hesitation longer than success. He stopped expecting things to return to how they were. Instead, he observed, watched how the system reacted to each move, each pause, each payment. That awareness changed everything. He no longer believed the illusion that following the rules guaranteed protection. Rules are guidelines, not contracts. He understood now why so many people feel confused, why they sense something is wrong but can't explain it. Because the system never explains itself. It doesn't need to. It already has leverage. His score remained high. That number stayed visible, comforting, deceptive. Access, however, never fully returned. That was the cost. Not debt, not failure, awareness. He did everything right, and the system still changed its behavior. Not because he failed, but because he stopped fitting perfectly. Systems don't reward growth, they manage deviation. The most dangerous belief is thinking good behavior protects you. It doesn't. Understanding does. Once you see how the system actually works, you stop chasing approval. You move differently, quietly, carefully. Because the system is always watching, even when it says nothing. And once it starts watching you closely, it never really stops.